What's up, Bitcoin Bulletin fam? Get ready for a rapid-fire update that's going to blow your mind. First up, get this. Deutsche Bank is projecting that Bitcoin could soon be joining the ranks of gold on central bank balance sheets. That's right, the institution that's been a bedrock of traditional finance is now looking at BTC as a potential reserve asset, and they're saying it could happen within the next 5 years. And it's not just Deutsche Bank looking at the big picture. We're seeing a global shift as regulations around digital assets become clearer. This move by central banks could fundamentally change how they operate, with Bitcoin potentially working alongside gold, not against it. We'll dive deep into what this means for the future of global finance and your portfolio. But is Bitcoin all smooth sailing? We'll break down the latest analysis showing Bitcoin stumbling in week 38, historically its third worst week on average. Is this just a temporary dip, or is something bigger brewing? We'll unpack the data, the options expirations, and what it all means for the current market sentiment. And finally, we're putting the ultimate crypto question to the test. Is it better to buy Bitcoin directly or invest in a company like Strategy, formerly MicroStrategy, which has built its treasury around BTC? Strategy has seen massive gains, but lately, things have gotten complicated. We'll help you decide where your next crypto investment should go. Don't go anywhere, and make sure you're subscribed and hit that notification bell. Bitcoin is poised to become a reserve asset for central banks, potentially joining gold on their balance sheets within the next 5 years, according to a new report from Deutsche Bank. This groundbreaking projection comes as global regulations for digital assets continue to clarify, paving the way for broader institutional adoption. Deutsche Bank's analysis suggests that Bitcoin won't replace gold, but will instead complement it as a reserve asset, reflecting a significant shift in traditional finance's perception of cryptocurrencies. The key factor driving this potential shift is Bitcoin's decreasing volatility. Historically, Bitcoin's wild price swings have been a major deterrent for central banks. However, Deutsche Bank points to recent data, specifically August, where Bitcoin's price surged to over $123,500, while its 30-day volatility dropped to a historic low of 23%. This trend indicates a maturing market, where price appreciation is becoming less correlated with extreme price fluctuations. As regulatory frameworks like MSTR in the EU and the UK's FCA crypto roadmap solidify, the bank anticipates further stabilization and deeper market liquidity, making Bitcoin a more attractive candidate for reserve status. The implications of this development are vast. If Bitcoin continues on this trajectory, it could signal a more sustainable growth path, attracting not only institutional investors, but also central banks looking to diversify their reserves. While the US dollar is expected to remain the dominant reserve currency, Bitcoin's integration could represent a significant evolution in global monetary systems. But can Bitcoin truly achieve this stability, or are we seeing a different story unfold in the market? Get ready, because we're about to dive into whether Bitcoin is stumbling or strategizing its next big move. Bitcoin is on the cusp of a major endorsement, with Deutsche Bank predicting its inclusion in central bank reserves by 2030, working alongside gold. This forecast marks a pivotal moment, signaling a transition from Bitcoin's perception as a speculative gamble to a potential cornerstone of global financial stability, a sentiment echoed by major traditional financial institutions. The primary catalyst for this predicted adoption is Bitcoin's declining volatility. In August, Bitcoin saw its 30-day price swings hit historic lows, even as its price surpassed $123,500. This demonstrated a newfound stability, with implied volatility dropping to just 32%, a significant decrease from its 50% yearly average. This reduction in volatility is crucial for its acceptance as a reserve asset, moving it away from its speculative past towards a more predictable future. Several nations are already taking steps that align with Deutsche Bank's prediction. The United States holds a substantial Bitcoin reserve, and El Salvador continues its national adoption strategy. Bhutan mines Bitcoin using renewable energy, and the Czech Republic is considering allocating a portion of its reserves to Bitcoin. Even individual American states like New Hampshire and Texas are establishing their own Bitcoin reserves, showcasing a growing acceptance at various governmental levels. However, challenges remain. Federal Reserve Chair Jerome Powell has stated the central bank cannot hold Bitcoin under current law. A University of Chicago survey also revealed economists' skepticism about the benefits of crypto reserves for the U.S. economy. Despite this, Deutsche Bank maintains that Bitcoin and gold will complement, not replace, the U.S. dollar, which still dominates global reserves. The bank emphasizes that governments will protect their monetary sovereignty, but the emerging trend of diversification, seen in China's reduced U.S. Treasury holdings, suggests a gradual shift is underway. While central banks consider Bitcoin, the market itself is showing signs of strain. Next up, we'll explore if Bitcoin is stumbling in week 38, or if this is just a temporary pause before its next surge. Bitcoin has entered its historically weakest week, with week 38 showing a consistent average decline, raising concerns about current market sentiment. This annual pattern highlights a recurring challenge for Bitcoin, as it faces potential downside pressure around this time of year, compounded by current market dynamics. Currently trading around $113,000, Bitcoin is already down nearly 2% for the week. The approaching September monthly options expiry, with a max pain level at $110,000 according to Deribit, suggests further downward pressure could be on the horizon. This max pain scenario indicates the strike price, where the largest number of options contracts would expire worthless, potentially maximizing losses for option buyers and influencing market direction. Further dampening enthusiasm, perpetual funding rates for Bitcoin have fallen to around 4%, one of the lowest levels seen in a month. These rates reflect the cost of holding leveraged positions, and a low positive rate suggests cooling speculative demand. Additionally, implied volatility remains near historic lows at 37%, indicating subdued expectations for significant price swings in the near future. Despite these short-term headwinds, Bitcoin is still up 4% for September and 6% for the quarter. With approximately 14 weeks left in the year, many of which historically yield positive returns, this period could be viewed as a calm before the storm. Meanwhile, gold continues its impressive rally, up over 42% year-to-date, potentially drawing attention away from Bitcoin. The booming performance of artificial intelligence and high-performance computing stocks, like IREN, may also be siphoning off investor interest in the short term. With these market dynamics at play, investors are asking a crucial question. Is it wiser to invest directly in Bitcoin, or is a company like Strategy offering a better path forward? The debate rages on. Is it a better buy to go directly into Bitcoin or to invest in Strategy, formerly MicroStrategy, a company whose stock has seen explosive growth tied to its Bitcoin holdings? Strategy has dramatically outperformed Bitcoin over the last 5 years, especially since the launch of spot Bitcoin ETFs, leading many to view it as a leveraged bet on the cryptocurrency. Since August 2020, Strategy's stock has surged over 2,300%, significantly outpacing Bitcoin's 900% rise. This divergence became even more pronounced in 2024, with Strategy up 450% compared to Bitcoin's 150% since January 1st. The prevailing sentiment was that investors could achieve amplified returns by investing in Strategy, leveraging its Bitcoin treasury. This strategy worked brilliantly when Bitcoin was booming and investors were willing to pay a significant premium for Strategy's holdings. For instance, in November 2024, Strategy's stock hit a 52-week high of $543, with investors attaching a premium of over 300% to its Bitcoin reserves. However, the landscape has shifted. According to K33 Research, that premium has shrunk dramatically to just 126%. This shrinking premium poses a significant risk. If the premium vanishes entirely, Strategy would be valued solely on its Bitcoin holdings, eliminating any advantage over buying Bitcoin directly. Worse, K33 Research notes that a quarter of Bitcoin treasury companies are now trading below the value of their Bitcoin reserves, potentially hindering their ability to raise capital and acquire more Bitcoin, which could lead to stock price collapses. Given these factors, the current recommendation leans towards buying Bitcoin directly. This offers pure exposure without the added risks associated with a company's need for continuous capital raises and potential share price volatility. However, Bitcoin itself is not risk-free. The failure of even one Bitcoin treasury company could trigger a negative chain reaction and a significant sell-off. Investors are urged to approach Bitcoin with a long-term perspective, not as a short-term momentum play. So, we've covered potential central bank adoption, market dips, and investment strategies. But what's the biggest takeaway from all this news? Stick around for our lightning round recap. And that's a wrap on today's Bitcoin Bulletin. We've seen Deutsche Bank predict Bitcoin joining gold in central bank reserves by 2030, highlighting its growing stability. We also dove into Bitcoin's historically tough Week 38, exploring whether it's a stumble or a strategic pause. Finally, we debated whether Bitcoin itself or a company like Strategy is the better buy right now. Don't miss out on any of the action. Smash that like button, subscribe to Bitcoin Bulletin for all your crypto insights, ring that notification bell so you never miss an update, and follow us on all social platforms to join the conversation. We'll see you in the next one.